So a top Wall Street strategist just dropped a prediction for Ethereum so massive it could completely change the crypto game. But is he a genius or is it all hype? We ran the numbers. In this explainer, we're going to break down his entire argument, pinpoint the one fatal flaw our analysis found, and reveal a data-driven strategy for what could really happen next.
All right, first up, the headline number that's got everybody talking. Tom Lee is forecasting that a single Ethereum could rocket to $16,000 in the near term. Just to put that in perspective, that's nearly a 4x move from where it's been sitting recently. It's a truly staggering target.
But wait, he doesn't even stop there. His long-term prediction has Ethereum soaring as high as $80,000. I mean, with numbers this big, you have to take a serious look at the logic. So the real question is, how on earth does he justify it? So what's the deal here? Is Tom Lee seeing a massive shift that the rest of us are just missing? Or is this whole thing pure fantasy? Let's find out. Look, we're not here to just guess. We've got an AI-driven analysis that has dissected his entire thesis, identified its biggest weaknesses, and helped build a data-grounded strategy. So let's get right into it.
Okay, so first things first, who is the man behind this massive call on Ethereum?
Yeah, Tom Lee isn't just some random voice on the internet. We are talking about a real heavyweight, a top-ranked Wall Street strategist with over 25 years of experience. And that includes his time as JP Morgan's chief equity strategist. You know, he was one of the very first major strategists to formally cover Bitcoin, which gives him immense credibility. So when he talks, Wall Street listens.
So what's his argument actually built on? Well, it all rests on what he calls three core pillars.
First, he's pointing to this completely unprecedented institutional demand shock. Second, he outlines a playbook that he calls the MicroStrategy of Ethereum. And third, he identifies what he believes is Ethereum's ChatGPT Moment. Let's break each one of these down. So pillar number one is all about simple supply and demand. You see this number, $37.2 billion? That's the value of Ethereum that's already been snapped up and basically locked away by all the new ETFs and corporate treasuries. This creates a huge supply shock. There's simply way less ETH available to buy on the open market. Pillar two is what he calls the MicroStrategy playbook. Think of it like this. A company's stock price goes up. They use that higher value, like their own personal ATM, to issue shares and raise cash. Then they use that cash to buy huge amounts of ETH, which of course pushes ETH's price higher. This validates their strategy, pushing their stock even higher. It's this really powerful self-reinforcing cycle called a reflexive loop. And this right here really nails his third pillar. Lee argues that stablecoins, those digital dollars built on the blockchain, are for Ethereum what ChatGPT was for AI. They are the killer app that finally brings mainstream utility to the network. With trillions of dollars in annual transaction volume, stablecoins are driving real-world demand for Ethereum's network every single day.
Okay, so that's the bull case. And you have to admit, it's powerful. And it's built on real trends. But our analysis uncovered a critical, almost mathematical flaw in how he gets to that near-term price target.
And here it is. Our analysis points to one specific calculation as the weakest link in his entire argument, his reliance on a historical ratio between Ethereum and Bitcoin. This is the magic number right here, 0.14. To get to his $16,000 ETH price, Lee assumes the ETH to Bitcoin price ratio will return to its all-time peak of 0.14, which happened way back in 2017. He's essentially betting that history is going to repeat itself exactly. But is that really a valid assumption? The thing is, the market drivers today are completely different from 2017. Back then, the ratio spiked because of the ICO mania, a wild speculative bubble where you needed ETH to invest in thousands of new tokens. Today's market is just so much more mature, driven by institutional ETFs, staking, and real-world utility. So the bottom line here is pretty simple. The markets aren't the same. You just can't copy and paste a ratio from a past bubble. Relying on the 2017 peak is a seriously flawed analogy, and it makes that $16,000 target feel highly speculative. So if we can't really rely on Lee's target, what does a more balanced, data-driven approach actually look like? Well, our analysis presents a clear alternative. First, we have to understand the current market tension. It's like a tug of war. On one side, you have optimism. Inflation is cooling, and the market expects the Fed to cut interest rates, which is great for assets like crypto. But on the other hand, there's pessimism from some weak underlying economic data, like a poor July jobs report. The market is caught right between these two forces. So, given this tension, what's a more prudent strategy? Here's the sample portfolio for a balanced risk profile that our analysis put together. 50% Bitcoin, 30% Ethereum, and 20% Solana. Let's break down the thinking here. The strategy is intentionally defensive. First, Bitcoin is overweight at 50%. With its massive ETF inflows, it acts as the digital gold anchor to preserve capital. Next, Ethereum is a neutral 30%. It's still our core growth asset, but we're tempering the allocation due to volatility. And here, our analysis suggests a much more conservative target, maybe testing its previous all-time high around $4,800 to $6,000. Finally, Solana gets a tactical 20% slice. It's the high-risk, high-reward play to capture potential upside while managing the overall portfolio risk. So after breaking all of this down, what's the final verdict on Tom Lee's wild prediction?
It really comes down to two simple things. First, the trend. Tom Lee was absolutely right to identify the powerful wave of institutional adoption. That is happening. But then there's the flaw, and it's in his math. The price targets he's promoting are built on a flawed historical analogy that our analysis just doesn't support.
And that brings us back to the actionable conclusion. Given the current economic uncertainty, the smarter play appears to be a defensive one. Overweight Bitcoin for safety, hold a core position in Ethereum for growth, and add a tactical slice of Solana for that high upside potential.
But now we want to know what you think. Is Tom Lee a visionary who's spotting the trade of a lifetime, or is his $16,000 target pure fantasy? Let us know your thoughts.